86 intraday, and the market behaved like that number cracked a seal. January was already up about 44%, and then the tape began threatening 10% daily ranges as if that was normal. A move like that is supposed to belong to thin, broken markets, not a flagship contract traded around the world. For years, people said triple-digit silver was a relic, something that could not happen again without a once-in-a-century distortion. Yet the chart printed it anyway, and the moment it did, the easy assumptions stopped working. Spreads jumped, liquidity felt patchy, dips stopped being orderly, rallies stopped being smooth. And the strangest part was that the most important forces behind the move weren't in the headlines. They were in the infrastructure, margin schedules, index rebalance windows, and risk systems that automatically tighten when volatility rises. That is the information gap. Most participants experience price first and explanation later. Institutions experience constraints first and price second. They already know when collateral gets tighter. They already know when a rules-based index must sell. They already know how concentrated positioning can amplify a squeeze in either direction. By the time a narrative reaches the public, large systems have often reacted. Here's the pattern interrupt. The most dangerous moments in markets are not when everyone is bearish. They are when price is screaming bullish while the plumbing quietly turns hostile. When that happens, the chart doesn't drift, it snaps. And once the snap starts, the market compresses what would normally take months into a handful of sessions. Welcome to Vault Line Macro. This channel is built for people who want the mechanics, not the memes. We focus on the flows, the rules, and the dislocations that show up before the crowd agrees on a story. If that's useful, stay close. And drop a comment with where you're watching from, because this squeeze in time isn't local, it's global. Now, what actually happened? The public sees a price milestone. The system felt a rule change. On January 13th, 2026, CME implemented a shift in how precious metals margins were calculated, moving to a percentage of notional framework for standard margins. Gold at 5% and silver at 9%. That sounds like a technical footnote until it is translated into behavior. In a percentage of notional system, as price rises, the required collateral rises automatically. The higher the price goes, the more cash must be tied up to carry the same exposure. Silver had already given a preview of how sensitive it was to collateral shocks. On December 29th, 2025, the March 2026 silver futures contract saw an intraday drop of about 11% on COMEX after a margin increase hit the market. The margin was raised by $3,000, from $22,000 to about $25,000. That is the kind of change that forces action. If a trader is leveraged, posting extra cash is not optional. If the cash isn't there immediately, the position gets reduced. And the market doesn't wait for someone to move money between accounts. So into January, silver wasn't just climbing on enthusiasm. It was climbing while collateral demands were getting heavier and volatility was expanding. That combination is what turns a clean uptrend into a fragile structure. Because fragility is not about direction, it's about funding. A trade can be right in the long run and still be forced out in the short run if the path becomes too violent. Then a second pressure arrived on a calendar, not a headline. Morgan highlighted the Bloomberg Commodity Index rebalancing window from January 8th through January 14th. $7 billion of gold futures selling. The estimate included around 13,000 COMEX silver lots, roughly 9% of open interest, and about 11,000 COMEX gold lots. Those numbers don't require anyone to be bearish. They require execution, because a benchmark must rebalance. Put those pieces together and the central mystery appears. Why would an asset that looks unstoppable suddenly trade like it's on a trapdoor? Because the trapdoor is not belief. It is collateral plus forced flow. A market can absorb a lot of opinions. It cannot absorb a lot of compulsory selling when volatility is already high and margin requirements are rising. This is where history helps, because this playbook is older than any one cycle. In 1980, silver's surge became a cultural moment, but underneath it was a structure built on leverage and financing. When constraints tightened and liquidity thinned, the repricing was fast and brutal. The story people remember is the peak. The lesson is the collapse of carry. In 2008, a different shock hit the system, and silver showed the same vulnerability. When liquidity is needed everywhere, assets that people assume are safe can be sold simply because they are liquid. The early phase wasn't a debate about value. It was a scramble for funding. That is why metals can drop sharply during broad stress, even if the longer narrative later favors them. In 2011, silver ran again with a familiar rhythm. Rapid gains, rising public excitement, and then a sequence of tightening constraints. Margin requirements were raised in steps. Volatility surged. The market didn't gently cool off. It went through a liquidation phase where the path punished leverage. The identical feature across 1980 and 2011 was not the catalyst. It was the mechanism. When leverage fuels the move, margin changes and volatility spikes are the pin that pops it. Now in 2026, the rhyme is obvious if the lens is right. In 1980, parabolic move, then constraints, then violent repricing. In 2011, parabolic move, then constraints, then violent repricing. In 2026, a parabolic move into a new margin framework that scales with price, plus a known window of index selling, and the market begins to trade as if it must reprice quickly to survive. The pattern isn't prophecy, it's a set of incentives repeating. So who is actually moving this? Markets are not a single crowd. They are multiple groups operating with different rules. First, there's the exchange and the clearing infrastructure. CME sets the baseline margin structure. Clearing members and brokers enforce it at the account level, sometimes with stricter house margins when volatility rises. Their mandate is not to be right about price. Their mandate is to manage credit risk and ensure the system settles. Second, there are the rules-based allocators. Commodity index funds and benchmark tracking pools don't wake up and decide they feel bullish or bearish. They rebalance, they roll, they follow formulas. That is why a projected 13,000 lot sell program matters more than 1,000 hot takes. Hot takes can change. A rebalance schedule is a machine. Third, there are systematic trend and volatility funds. Many of these strategies size positions based on volatility. When volatility rises, they reduce exposure. That reduction can be independent of direction. In other words, a market can be in an uptrend and still see systematic selling because the volatility target forces risk to come down. This is how a bullish price environment can still produce heavy selling. Fourth, there are commercial hedgers and producers who use futures for risk management. Their actions can look bearish in the futures market, but their goal is often to lock in cash flow, not to call a top. When price spikes, hedging activity can increase because the price offers a rare chance to fix terms. Finally, there are large concentrated traders who can dominate certain categories of open interest. This is where the data becomes specific. In the CFTC Commitments of Traders report dated January 27, 2026, COMEX silver open interest was listed at 156,637 contracts, 2% of gross short open interest. Concentration does not automatically imply wrongdoing. It implies sensitivity. When a handful of nodes carry a large share of exposure, the system can swing hard when those nodes adjust risk. There's another layer to that concentration number that matters for how violent a move can become. Gross shorts held by the largest traders often include hedges, spreads, and inventory-linked positions, while many longs are scattered across smaller accounts using leverage. In a calm market, that mix can look stable. In a stressed market, it creates an asymmetry. A concentrated player can manage risk with balance sheet tools and time, while a fragmented set of leveraged longs is forced to react with the same blunt instrument, selling into the same window. That is why a margin event rarely looks like a thoughtful reallocation. It looks like a waterfall. It declines because the weakest funding structures are removed first. Think about how a broker actually manages risk. Brokers monitor accounts against maintenance thresholds. When volatility rises, they can raise house requirements above the exchange minimum. They can reduce offsets that previously allowed capital efficiency. They can tighten intraday controls and require faster collateral movement. If the account cannot comply, the position is reduced. This is also why the language around margins can be misleading. People hear, margin went up, and imagine a one-time bump. In reality, it is an ongoing relationship between price, volatility, and collateral. When price rises and the margin framework is percentage-based, margin goes up automatically. When volatility rises, risk models tend to demand additional buffers. And when a participant's equity fluctuates with price, the account can flip from comfortable to stressed in a single session. The market doesn't wait for a monthly statement to reveal that stress. It shows up immediately in liquidation. The moment that happens across enough accounts, liquidity becomes conditional. Market makers widen spreads because the risk of being run over increases. Some reduce size, others step back entirely. That is how a liquid market can feel illiquid without any dramatic external news. It is not that trading stops. It is that the price of immediacy rises and the depth behind the best bid and offer thins. You could see this change in behavior around the triple-digit milestone. A milestone price attracts attention, but it also attracts positioning. Late participants arrive. Short-term traders increase leverage because the move feels obvious. And when leverage increases late in the move, the system becomes more sensitive to the smallest constraint. This is why the phrase late longs are fragile exists. It doesn't insult anyone. It describes funding. Now put yourself in the seat of a rules-based manager during that week. A rebalance window is approaching, risk is rising, spreads are widening. The mandate is to follow the index, not to improvise. That manager sells because the model says sell. Meanwhile, a volatility target strategy reduces exposure because realized volatility is breaching its threshold. Meanwhile, a broker tightens requirements because intraday ranges are expanding. None of those actors is thinking about the same narrative, yet all of them produce the same directional pressure at the same time. The news is the excuse, the rule is the cause. And once the rule is active, the market begins to anticipate the forced flow because participants know when it lands. Some sell early to avoid selling into the crowd. Others hedge. Others step away, which reduces liquidity and makes the flow more impactful. The system is reflexive, and reflexivity is strongest at extremes. This is why the December 29th, 2025 episode matters as a warning flare. An 11% intraday drop on a margin change is the market telling you leverage is high and resilience is low. When that happens, the next big move is less likely to be smooth. It's more likely to be discontinuous. And discontinuous moves are where perception flips from confidence to caution in a single session. Now add the timing. The margin framework shift was implemented on January 13th. The index rebalance window ran January 8th through January 14th. That overlap is not a conspiracy. It is coordination through calendars. The system lines up these pressures naturally because different parts of the market follow their own rules, and sometimes those rules collide. But it's often just the market obeying constraints. A broker tightening margin on a client is not making a macro call. A benchmark rolling exposure is not making a macro call. A volatility target fund cutting risk is not making a macro call. Yet when all of them happen together, the macro price moves anyway. And this is the part no one is discussing: dislocation. Two parts of the market can tell opposite stories at the same time. Paper markets can scream liquidation while immediate demand signals stress. Futures can be dumped in seconds. Physical supply chains cannot. In calm times, arbitrage keeps those worlds aligned. In stress times, arbitrage becomes balance sheet limited. When collateral is tight, a trader who would normally buy a dip and carry inventory has to ask a different question. How much funding does it take to hold this position through volatility? If funding costs rise, and if risk limits tighten, the arbitrage link weakens. That is when price can fall sharply, even as near-term availability feels scarce. It looks contradictory, but it is a simple consequence of constrained balance sheets. Dislocation can appear in several measurable ways. It can appear in the relationship between nearby and deferred futures, where the front end behaves differently from the back end. It can appear in spreads that move more violently than the outright price. It can appear in unusual gaps between paper pricing and what immediate transactions imply. And it can appear as geography, where one region pays a premium for immediacy, while another region trades off the futures tape. The key concept is that paper is where leverage lives. Leverage is where margin calls live. Margin calls are time compressed. A physical market can be tight and still see paper sell-off because paper participants are meeting deadlines, not expressing long-term beliefs. That is why, in the snap phase, paper can overshoot. It is not a vote. It is a clearance. And once the paper market overshoots, the dislocation cannot persist indefinitely. Either paper drops enough that demand cools and supply responds, or the tightness in immediacy forces the structure to adjust and pulls paper back. Markets resolve dislocations. The only question is the path. In a snap, the path is noisy. So how is the snap executed in practice? Start with the basic fact of futures. Positions are marked to market and settled through variation margin. When price moves against a leveraged position, the account must post more collateral. If it can't, the position is reduced. During calm periods, this is routine. During volatile periods, this becomes a cascade. Now layer in procyclical margin logic. Under percentage of notional margins, a rising price increases required collateral. Imagine a contract that represents 5,000 ounces of silver. At roughly $100 an ounce, the notional is about $500,000. 9% of that notional is around $45,000. That means the act of holding exposure at high prices can demand substantially more collateral than it did at lower prices, even before price moves. The trade gets heavier as it rises. Here's an analogy that makes this clear without dumbing it down. Picture a bridge that allows trucks to pass, but the bridge's toll increases as the truck's cargo value increases. The better the cargo, the higher the toll. A truck can still make the trip, but it needs more cash to cross. In markets, margin is the toll. And when price rises, the toll rises. If too many trucks arrive without the extra cash, traffic stops and vehicles turn back. That turning back is forced selling. Now add the timed gust of wind, index selling. If a benchmark must reduce silver exposure during a rebalance window, that selling is executed into whatever liquidity exists. If liquidity is already thin because participants are conserving collateral, that selling impacts price more than it would in a calm regime. It is that the index is large and indifferent to narratives. The cascade follows a familiar cause and effect chain. Price rises fast. Volatility rises. Margins tighten or become more demanding. Some participants sell to meet collateral needs. Selling increases volatility. Systematic funds reduce exposure because volatility targets are breached. Liquidity thins. Spreads widen. Dips become sharp. The market snaps. One more dislocation tends to appear in these moments. the split between what feels true in conversations and what is true in settlement. When volatility is high, the difference between those words becomes a price. Participants who can fund positions calmly can take the other side of forced flow. Participants who cannot fund calmly become the flow. That is why the market can print a series of dramatic candles that feel disconnected from the longer story. And if the market is still absorbing compulsory selling, rebounds can be deceptive. A rebound can be driven by the absence of sellers rather than the presence of strong buyers. It can be driven by short covering because risk limits demand it, not because conviction changed. That is why watching open interest on rebounds matters. If price lifts while open interest falls, the rally is often a release valve, not a new foundation. In snap regimes, the clean signals vanish and the only reliable compass is whether the system is healing. Tighter spreads, calmer ranges, steadier open interest, and fewer forced sellers at the close each day. So what does this imply from here in a way that stays grounded? Historically, when a market reaches a milestone price, posts extreme monthly gains, and then collides with margin mechanics plus scheduled institutional flows. The next phase is usually defined by volatility and positioning changes. The market searches for a level where exposure can be carried without emergency funding. There are a few broad scenarios that tend to show up. In a conservative scenario, the market experiences a sharp shakeout, realized volatility falls, and price builds a base while open interest stabilizes at a lower level. In a moderate scenario, the market sees multiple waves: a liquidation, a strong rebound driven by short covering, then a second liquidation as fresh leverage re-enters too early. In a more aggressive scenario, dislocations widen and liquidity remains thin, producing larger intraday moves until participation is reduced enough for stability to return. What matters is what the data reveals along the way. Watch realized volatility because it governs systematic sizing. Watch open interest relative to price because it hints at whether leverage is leaving or returning. Watch whether rallies rebuild open interest or simply lift on reduced participation. Watch the behavior of spreads and nearby pricing because that is where stress shows up first. And watch the calendar for forced flows because machines do not wait for sentiment to catch up. This creates the divide. One group experiences the market as a series of emotional surprises. The other group experiences it as a system of constraints expressing itself through price. The difference isn't intelligence, it's attention. It's the willingness to look beyond the candle and ask what forced the candle to exist. Information gaps become wealth gaps because institutions act on constraints before the crowd gets the story. Rules-based funds move on schedules. Brokers move on risk. Exchanges move on volatility. Those decisions happen first. The narrative comes later. And when the narrative arrives, it often describes the outcome as if it was a choice, when it was really a requirement. If this sounds cold, it's because markets are cold. They settle in cash. They settle on time. They don't care how compelling a thesis is if the margin isn't there. That is why the snap matters more than the headline. A snap is the market admitting the carry structure broke. Bring it back to the number that started this. 33 on January 23rd, 2026 was not just a close. It was a signal that a new regime had arrived, one where mechanics could overpower narrative and compress outcomes into days. This is Vault Line Macro, where we decode what matters before its headlines. If these dots felt connected, keep watching the constraints, margins, forced flows, volatility, and concentration. The question isn't whether the market will have another dramatic session. Historically, it often does after a snap. The real question is whether the next move will be seen as random chaos or as the predictable consequence of the system tightening at the exact moment the crowd thought the trend was untouchable.